Good evening. Now, cast your minds back to 2008, a time when the world collectively decided that skinny jeans were a good idea for everyone, and the global economy decided to spectacularly soil itself in public. At the heart of that mess was the collapse of Lehman Brothers, a 158-year-old investment bank that went down with all the grace of a hippo falling off a unicycle. Its bankruptcy was the single largest in United States history, and it acted as the starting gun for the worst financial crisis since the Great Depression. You probably remember the headlines, the panic, the endless news reports of grim-faced men in expensive suits carrying cardboard boxes out of gleaming skyscrapers. It was, to put it mildly, a complete and utter shit show. But how did it happen? How did a titan of Wall Street suddenly become the financial equivalent of a Jenga tower with all the bottom blocks pulled out? Well, while the full story involves a toxic gumbo of subprime mortgages, deregulation, and pure uncut greed, a key ingredient in Lehman's secret sauce of disaster was a nifty little accounting trick. It was a piece of financial sleight of hand, so brazen, so audacious, that it allowed them to hide tens of billions of dollars in debt. It was a magic trick, really, only instead of pulling a rabbit out of a hat, they pulled the rug out from under the entire global economy. So, tonight, we're gonna pull back the curtain on that trick. We're gonna look at what it was, how it worked, and why this seemingly boring bit of creative accounting had such catastrophic consequences for, well, pretty much everyone. We're gonna talk about something called Repo 105. And I know what you're thinking, Repo 105. That sounds like a forgotten Steven Seagal movie where he repossesses a nuclear submarine. And you're not wrong, but the reality is somehow even more ridiculous and infinitely more destructive. So buckle up, because this is the story of how a few clever keystrokes on a balance sheet helped bring the world to its knees. So, what in God's name is Repo 105? Well, let's start with a regular repo, which is short for a repurchase agreement. It's a completely standard, boring as hell financial tool. It's essentially a short-term loan. Imagine you need cash, so you give me your slightly used Xbox as collateral. I give you cash, and we agree that tomorrow you'll buy back your Xbox for a slightly higher price. That small difference is my interest. It's a loan. You get your cash, I get a small profit, and everyone's happy. In the financial world, banks do this constantly with assets like treasury bonds. It's all very normal. The key thing here, for accounting purposes, is that everyone agrees it's a loan. The Xbox, or the bonds, are still considered your property, and the cash I gave you is a debt on your books. Simple. Now, this is where Lehman Brothers got creative. They took this perfectly normal transaction and gave it a diabolical little twist. With Repo 105, they argued that because they were receiving only $100 in cash for every $105 worth of assets they were putting up as collateral, it wasn't really a loan. They claimed that this 5% haircut meant they had surrendered so much control over the assets that it was, in fact, a sale. Think about that. It's like saying that because you sold your $300,000 house for $285,000 with an agreement to buy it back in a week, you didn't take out a loan, you just briefly sold your house. It's a semantic distinction of such breathtaking audacity that you almost have to admire it. It's the financial equivalent of telling your partner you didn't cheat. You just engaged in temporary non-spousal intimacy. And why go to all this trouble? Why perform these linguistic gymnastics? Because if these transactions were classified as sales instead of loans, something magical happened on Lehman's balance sheet. The tens of billions of dollars in cash they received wasn't booked as debt. Instead, they could use that cash to pay down other debts just before they had to report their financial health to the public at the end of a quarter. The assets they had sold were temporarily off their books, and so was the corresponding debt. Their books looked cleaner, healthier, less leveraged. It was a financial cleanse, a corporate colonic. The only problem is, just like a colonic, it's full of crap, and the second the quarter ended, they'd buy the assets back, the debt would reappear, and they'd be right back where they started. Okay, so they cooked the books. So what? Companies fudge numbers all the time, right? Well, yes, but this mattered because in the high-stakes world of investment banking, perception is reality. The most important currency a bank has isn't the dollar, it's trust. Investors, lenders, and other banks need to believe you're financially sound before they'll do business with you. A key metric they use to judge this soundness is the leverage ratio. Essentially, how much you've borrowed compared to how much you actually own. It's like your personal debt-to-income ratio, but instead of deciding if you can afford a new Kia, it determines if the entire financial system will give you hundreds of billions of dollars to play with. Lehman's problem was that its leverage ratio was getting terrifyingly high. They were borrowing more and more money to make increasingly risky bets on the housing market. If their true leverage was known, investors would have run for the hills, credit rating agencies would have downgraded them, and their borrowing costs would have skyrocketed. It would have triggered a death spiral. So, Repo 105 became their wonder drug. At the end of every quarter, just before their big checkup with the public, they would furiously engage in up to $50 billion of these Repo 105 transactions. This temporarily pushed down their reported leverage ratio, making them look strong, stable, and responsible. It was a lie, of course, but it was a very convincing, beautifully presented lie printed on glossy paper. This created a completely false sense of security. Imagine a pilot telling passengers, "Our altitude is a perfectly safe 30,000 feet, while conveniently failing to mention that the measurement was taken 5 minutes ago while the plane was in a nosedive." That's what Lehman was doing. They were presenting a snapshot of health that was deliberately misleading. Investors and counterparties looked at Lehman's polished numbers and thought, okay, they seem to have their house in order, they're a safe bet. They continued to lend them money and trade with them, propping up the bank and allowing it to continue its reckless behavior, all based on a trust that was fundamentally, catastrophically misplaced. The whole system was running on faith in a phantom. For a while, the trick worked. The music kept playing and Lehman kept dancing, but by 2008, the subprime mortgage market, the very thing Lehman had bet the farm on, was imploding. The assets they held were turning toxic, and the losses were piling up faster than they could hide them. The market was getting nervous. Whispers about Lehman's true health started to spread. Other banks, like Bear Stearns, were already teetering, and the entire financial world was on high alert. People started looking closer at Lehman's books, and the weirdness of their accounting couldn't be ignored forever. The magic was starting to wear off, and the audience was getting restless. The breaking point came when the market lost faith. As the crisis deepened, other banks became unwilling to be the counterparty for Lehman's Repo 105 deals. They either didn't have the cash, or they were finally realizing that taking on Lehman's increasingly sketchy assets, even for a few days, was too risky. The wellspring of short-term funding that Lehman used to mask its problems dried up almost overnight. Suddenly, they couldn't perform their quarterly magic trick. When they reported their next set of numbers, they couldn't hide the enormous mountain of debt and the staggering losses. The beautiful snapshot of health was replaced by a gruesome crime scene photo. This was the moment the panic truly began. The revelation that Lehman was not just in trouble, but had been actively deceiving everyone about the scale of its trouble, shattered the last vestiges of trust in the institution. It was like discovering your most reliable friend is not only a gambling addict, but has also been secretly maxing out your credit cards. No one would lend to them. No one would trade with them. On September 15, 2008, unable to fund itself, Lehman Brothers filed for bankruptcy. This wasn't just one bank failing, it triggered a chain reaction. Every other bank that had lent money to Lehman, or was expecting payment from them, was suddenly facing huge losses. The intricate web of trust that holds the global financial system together tore apart, leading to a full-blown panic, a credit freeze, and the crisis we all remember. After the dust settled, or more accurately, while the dust was still a choking, globe-spanning cloud, the investigations began. A court-appointed examiner, a lawyer named Anton Valukas, was tasked with performing the corporate autopsy on Lehman. His 2,200-page report was the financial equivalent of the Zapruder film, and in it he laid bare the Repo 105 scheme, calling it accounting gimmickry designed to create a misleading picture of the firm's financial condition. The report concluded that there were colorable claims against senior executives, including the CEO Dick Fuld, for misleading investors. It was a damning indictment, a detailed instruction manual on how to blow up a bank. Naturally, the next question was, where the hell were the auditors? The firm responsible for signing off on Lehman's books was Ernst & Young, one of the Big Four accounting firms. Their job, their entire reason for being, is to act as the independent umpire calling balls and strikes on a company's financial statements. Yet, they had approved Lehman's use of Repo 105. In their defense, they claimed that while they knew about the transactions, they believed Lehman had the legal opinions to back up the sale accounting treatment. This is a bit like a food inspector saying, "Well, I saw the rat in the soup, but the chef had a note from his cousin saying the rat was a beam-fime, abrajuspam, flavor, enhanensiken for ensirent, danger, so my hands were tied." It was, to be generous, not their finest hour and led to widespread criticism that auditors were too cozy with the clients who paid them. The fallout from this whole debacle did lead to some changes. It was a massive, system-shattering wake-up call. In the aftermath, accounting standards boards in the United States and internationally tightened the rules around repos to make it much harder to classify them as sales. The new rules essentially say, if it looks like a loan, smells like a loan, and functions like a loan, you have to call it a loan, you creative little sociopaths. The Dodd-Frank Act also introduced sweeping new regulations for the financial industry. But the ethical questions linger. The fact that top executives in a major accounting firm could preside over such a blatant deception with few personal legal consequences remains a source of deep, public anger. So, let's boil this down. Did Repo 105 cause the 2008 financial crisis all by itself? No, of course not. That would be too simple. The crisis was the result of a perfect storm of factors: a housing bubble fueled by cheap credit, the creation of ridiculously complex and risky financial products nobody understood, a total failure of regulation, and a culture of short-term greed on Wall Street. That's the big picture. But Lehman's use of Repo 105 wasn't just a footnote. It was a crucial catalyst that turned a growing crisis into a full-blown catastrophe. It was the match thrown onto a giant pile of oil-soaked rags. What Repo 105 did was allow Lehman to delay its day of reckoning. It was a painkiller that masked a fatal disease. By systematically misleading the market about its own health, Lehman was able to keep borrowing and keep making its bad bets long after it should have been forced to stop. They kept the party going on, borrowed time and borrowed money. This deception ensured that when the bank finally did collapse, it was from a much greater height and with far more connections to the rest of the financial system than it otherwise would have had. The surprise and the scale of the collapse were magnified tenfold by the preceding lies. Ultimately, the story of Repo 105 is a story about confidence. For months, Lehman's executives projected an image of strength, reassuring investors that their foundation was solid, all while knowing it was riddled with cracks they were actively papering over. When the truth finally came out, it wasn't just confidence in Lehman that evaporated, it was confidence in the entire system. It revealed that the official numbers couldn't be trusted, that the auditors weren't watching, and that the people in charge were willing to lie to protect themselves. The catastrophic loss of confidence that followed Lehman's bankruptcy is what froze credit markets and plunged the world into a deep recession. The trick didn't just hide the debt, it hid the truth, and when the truth came out, it took everyone down with it. So, there you have it. Repo 105, a term that sounds like a boring accounting elective but was, in reality, a weapon of mass economic destruction. The story of Lehman Brothers is a stark reminder that the things that sound the most technical and boring, leverage ratios, accounting standards, repurchase agreements, can have profound, world-shaking consequences. They are the hidden plumbing of our economy, and when that plumbing is deliberately sabotaged with gimmicks and tricks, the entire house gets flooded with sewage. It's a lesson that what happens in the obscure corners of finance doesn't stay in the obscure corners of finance. It ends up on your street, in your pension fund, and at your kitchen table. The key takeaway here is not that all finance is evil, or that every banker is a cartoon villain twirling their mustache. But it is a powerful argument for skepticism. It's a reason to raise an eyebrow when a company reports impossibly good results quarter after quarter, or when a CEO dismisses serious concerns with a wave of their hand. The financial world loves to present itself as a realm of wizards performing complex magic that we mere mortals couldn't possibly understand. But often, when you pull back the curtain, you don't find a wizard. You find a man frantically pulling levers and pressing buttons, hoping you don't notice the smoke coming from behind the screen. So, stay curious. Ask the dumb questions. If something looks too good to be true, it almost certainly is. Because while the next crisis might not involve a trick called Repo 105, you can be sure of one thing. It will involve its own brand of magic, its own clever justifications, and its own set of people telling you not to worry about the man behind the curtain. And as we learned in 2008, paying attention to that man is not just a good idea. It's a matter of survival. Thank you, and good night.